Hey guys, this is Mubashir Ansari, and today we are going to analyze about the JG Chemicals. Basically, we are going to analyze its fundamentals and technicals too, like we do for every stock, right? So, first of all, I think it is very important to cover the Nifty 50 and Sensex. What's happening with that? I mean, you know that the market is continuously going down, right? But if you look at the today's chart, you come to know that it is market was up around 1.8%. The main reason because behind this is that you know that Donald Trump has shown some kind of positivity towards this war. I mean, he said that they are going to don't launch any missiles towards the Iran for the 5 days. They are postponing that. So that shows that there is a kind of stability in the this geopolitical tension, right? But before that, you know that market is continuously going down for the past we can say around 24 days. Let me show you the chart for the entire month, right? Monthly chart. Come to know that this single candle is down around. Let me show the chart. Was down around 10%. Now because of this positive news, it is around 8.5% across. So yeah, the market is continuously going down. Also, if you look at the gold, you come to know that it was also going down because of all this dollar is stacking, and as you know that gold is priced against the dollar, right? So whenever the dollar price is rises, the gold goes down. Whenever the dollar price move downwards, gold gold goes up. That's the thing. It is like we can say inverse relationship between that. Right? And also there is a profit booking for the gold. That's the, also reason, and because of this oil prices were continuously going upward direction. That leads to there is a chance that the inflation is going to up for the overall economy, and that leads to RBI, central banks like RBI, they are going to, we can say, increase the repo rate, interest rate, right? So that leads to people start moving their safe asset money towards the FDs and all, so that they are going to get the more returns. That leads to the selling pressure for the gold. That's also the reason because the gold was going down. So it is kind of cyclic. Let's forget about that. I mean, we have to cover the JG chemicals, right? So let me show it to you. So as the name says, it is like a chemical based company. Let me tell you about that. JG Chemicals. Like once since we have covered like any company, that's the reason I have thought that we need to cover like any single company. So that's the reason I have thought to what about the JG Chemicals. Through this, we can also understand that if these kind of companies are impacted or not because of this war and all. Right? And also because of this geopolitical tension which was happening around for the 3 to 4 months between the India and US. As you know that Donald Trump has imposed too much tariff on India, right? So let's see for this quarter was the result. Okay. So first we need to check what this company do. So this JG Chemicals Limited incorporated in 2001. Okay, it is kind of is been 2.5 decades since it has launched this business. JG Chemicals is a leading zinc oxide manufacturer having the capability to produce up to 80 grades of zinc oxide. So I think it is more specific to the zinc oxide. It is not don't have any like diversified portfolio. It's mainly focused on the zinc oxide. Okay. So leading zinc manufacturer JG Chemicals is the largest zinc oxide manufacturer in India with a 30% market share. We need to note down that. I mean 30% market. They are having like we can say they having like monopoly in the Indian market, right? Because they are manufacturing on 30%. They are having a market share of 30% in the India. Right? So if we talk about the manufacturing capacity, we can see that okay, we need to look at the expansion plan co was to set up a new greenfield manufacturing facility with zinc chemicals in Gujarat. They are planning to uh, set up their new facility in the Gujarat. Okay, they are planning to increase their production capacity. Right? As per that we can understand. So let's see their competitive edge, because I think that's the main point we need to look at for this company. Strong recycling technology uses 73% secondary zinc, reducing the energy consumption by 82% and carbon footprints by the 70%. That's the very good thing. Okay. Direct sales model, 95% of the sales are direct to the end customers. Okay. So they are not having like the, we can say they don't have any mediator for them. That's the reason they are going to earn more profit margin. I mean, because of all these mediator things, the profit margin reduced, right? If as they told that they have like 95% of TCS directly to the customers, so that leads to their profit margin increases, right? Heavy entry barriers, right? We need to look at that too. The product takes long approval time, like 4 to 5 years for the tire industry with a stringent regulatory standards. Okay, so in order, if you want to start your business in this zinc business, you need to go through the like 4 to 5 years of process, regulatory process and all. So that creates a entry barrier for other competitors. So that's the also the good thing for this company, right? First of all, this company mainly manufactures zinc oxide, right? JG Chemicals. And the second thing is that they have a monopoly, we can say. They have a market share of 30% in India. And the tertiary things is that they are also not that much, but yeah, they are also planning to set up their manufacturing capacity in the Gujarat as per their expansion process, right? And the main competitive advantage that they are getting is that they the this we can say long waiting approval for the 4 to 5 years for this all these paperwork. If any company want to start their business in this outside business, okay. So first we need to go with the like technicals. The main reason I have covered this about part, you know that we first need to know about this company. Then we are going to analyze its technicals, and based on that, we are going to analyze its fundamentals too. Okay. So let's JG Chemicals. Okay. Okay. Yes. Okay. They have recently launched their IPO, so we need to look at the chart of for the one day. So So from the, it was listed in the stock market around Web 13, 2024. Sorry, Wednesday 13 March. So it's been around 2 years since this stock has been launched in this stock market. So in within 2 years, it has given around the around 83% return, we can say. Within 2 years, this stock has given 83%. And if I talk about the all-time high, it has around 200% returns. That's a good thing. But if I check from it is all-time high, it is now doing it at 14% low. And this main, okay, from it is all-time high, it is down around 40%. And if I talk about this past month, from this from the March, first March. Okay, we need to look at from the first March from here. So the past from the start of this war, it is down around 10%, we can say. And from the start of this tariff, we can say it is down around the tariff was started. I don't know exact result. Then I don't know. Actually, I don't remember the exact date of that, so we need to look at that. Okay, February 20. Okay, in the year February 2020, it's in the February. So we need to start looking from the February. Okay, February. Actually, there is no specific date for that. Okay, actually the Feb was started here. Okay, but it has gone very up from there. I think because of some reason the stock was giving very good returns. but after the this tariff things, it is down around 20% we can say. So if I overall tell you about the technicals, it is now trading at around it is discounted price based on the PS. Sorry, P and EPS. We are going to decide. Okay, we are going to check this data too. Okay, so first of all, we need to look at this ratios. Okay, so the market cap is around 1283. That is 1283 crores. So it is, we can say it is a micro cap company. Right? And the secondary thing is the P is 20 only. If I compare it with the industry P, so it is around 14 15 we can say. So it is quite little bit higher as compared to it is industry. We are going to check why it is high. Okay, return on capital employed and return on equity is quite we can see good. Okay, the promoter holding, it is very good. I mean, whenever I check the company, I prefer this company who have like a higher promoter holding, like 71%. My minimum consideration is around 42, more than 40, we can say. So, interest coverage ratio is too much good. That means company is having very less debt. Okay, as you can see that it is around 0.0, sorry 0.01. Okay, so EPS good for the 5 years. It is very bad. That's very bad. That's very bad. Quality ratio is too much high. That's not that is they're having like they have more current assets. Okay, they have too much current assets, and the current ratio is more than that. That means the more inventory is sitting in their godown side. And if I talk about the book value, is that so the price to book value is around 2.61, where the industry price to book value is only 1.1. So that's why that this company is quite expensive as compared to others. It is industry peers. Okay. Okay, so for the 5 years it is quite good, but the EPS was not doing well. So I think there is a margin problem. Let's see. The dividend is company is giving dividend, that's good sign, but it is only 0.3%. Okay, EV to EBITDA is good. Okay, PAG ratio. That's also good. I mean, if I would say nowadays, if you see any company, you come to know that this is more than two, right? So not the more than two, it is around 1.3, 1.4. So based on that, I'm telling you that is good. I mean 1.2 around. Okay. So if I let's check the it's been around 2 years since this company is launched. So let's check the EPS and PE data. And, okay, from here. It was having a P of 12 and the EPS was 17, and P was continuously increasing, but the EPS was down. And as you can see, there is a okay, P again high. As you can see, through entire this P and EPS trend, you can observe that the P was constantly increasing or decreasing, but EPS was gradually decreasing. It was not increasing overall, I would say. So company is not able to increase their profitability, as I told you here, based on that APS. Even thought their sales was increasing, but their APS was not increasing. It was even going down continuously. Right? So let's see their quarterly result. So I think the pair comparison, short pair comparison, is going to be a very good idea. Okay. So as you can see, the market cap is sorry, current market price. We are not going to connect market cap. We are also not going to connect. Okay, if I talk the quarterly sales variance, but this company is doing very well as per the sales, right? As a percentage. Tag ratio is also good as compared to other company. EPS for the 12 months is quite acceptable. I mean, it is too much fluctuating for other companies, right? Sales variance for the 5 years is also good if you compare with the PS. And profit variance for the 5 years also we can say excellent it is, right? Interest coverage is also good. Current market price to the book value is quite acceptable, not that much good we can say. As you can see, the average is 1.35, but here it is 2.61. EV to EBITDA, it is quite we can say acceptable. Current market price to the sales is also good. Return on equity and return on capital employed is also good. Debt to equity excellent. P is also good. Okay. So overall, if I talk about the peer comparison, this company is doing very well. Okay. Now, what televisions? As you can see, within the span of around, we can say, uh, like uh, 1.5 year, you can see the from 200 crores to the 250 crores. So we can say that's the gain of around 25%. We can say 25%. So that's good, not that much bad. Operating profit margin is not increasing. It is quite from here. If I talk about the for the past 1 year, it is quite constant. They have tried to increase it, but they are not able because if you see the expense, the major cost for them it is material cost. Okay, as you can see, the material cost was increased. Right. I think this is because of this all these taxes, GST and all. Their material prices fluctuate too much for especially for the chemicals. Right? That leads to their margin also fluctuate, but still they are maintaining like quite kind of good margin that is of 9%. Okay. Depreciation is remains same. APS, as you can see, APS is also slightly increased. So if I check sales growth, okay, in 2020 they were having around 400 crores of sales. Now they are having around 850 crore of sales. That's the increase of around 100% within 5 years. That's a very good sign for the company. Right? But if I talk about the operating profit margin, let's first see the expensive material costs remain the highest. As you can see, they have increased their overall efficiency in terms of buying the material. You can see from 85% to 80% only, and that leads to their operating profit margin has been increased from 5% to 10%. So that's a very good thing. Okay, and their interest obligation is also reducing. As you can see from 3 crore to 1 crore. And the appreciation is increasing because they may be buying more assets for that. Okay, and if I talk about the EPS, earning per share, I think there is a miscalculation here because of which this is reducing here. There's a miscalculation by the scheme. Anyways, let's go with the balance sheet. Equity, you can see that they were having more equity reserve. If you can see, they are increasing exponentially. Within the span of 4 5 years, they have increased their reserve exponentially. That's a very good sign for the company. Borrowings, if I would say, their borrowing is continuously reducing. As you can observe, the long-term borrowing has been there is no long-term borrowing you can say, and for the short-term borrowing is only 5.11%. Okay, fixed asset, as I told you, they have increased their fixed asset from around 1.5 crores to the 4 crore. Building is also increased double. Everything has been double because so they are continuously expanding, right, as I told you. And current working process is very 1% investment. They are also doing some investment here from 6 crore to 15 crore. That's a very good sign for the company. So overall, as per the balance sheet, their balance sheet is excellent, right? In terms of values, their investment, they are continuously doing investment for the fixed assets. Their borrowing is less. They are continuously increasing their reserves. So yeah, that's a very good sign. Let's see the actual cash flow. Okay, cash flow from the operating income. That's around we can say 3170. That is we can say around 100 crores. If I deduct it like 90 crores, right? Within 3 years, they have generated around 90 crores. And if I tell you here, yeah, within 3 years, they have generated around uh, yeah, 90, 130, and 70, around if I account this appreciation, then it is around 200 crores. So they have collected 90 crores and they have done a sale of 200 crores. So they are collecting around 50% of their overall sales, right? So I personally consider it as a good sign. Not you're saying that from 200 crores they are able to collect only 100 crores. So that's the 50% around, right? So as per my observation, as I have observed too many companies, I come to know that most of the companies normally have 40, 45, 50% of their cash flow as compared to their profit and loss statement, right? Whatever they say, whatever the sales they done. So that's not a concern, that's a good sign, right? But this should be remain 50% and it should increase, not reduce, okay? Because receiver should not increase continuously, right? As you can see, their receivers is uh, continuously is increasing. Inventory, there is also inventory is increasing, as I told you. Their inventories has been increasing exponentially, and receivers is increasing. Okay, this asset passes as we have already observed. And repayment of borrowing, they are continuously paid their borrowings. As we saw that they have nil borrowing for the long term and have very short term borrowings only. So overall, they are doing very well. And if you see the debtor days, their debtor days is increasing. It is quite concerning, not that much. If I would say that is okay, inventory days has been also increased. That's a very bad sign for the company. Okay, they are producing more inventory, but as compared to what is being sold, right? I think it is happening because their sales has been increasing. As we saw that from 2020 to 2025, their overall revenue has been increased by the 100% across. So that's the reason, because of they are doing very more sales, and that leads to they have to produce more, and that leads to their inventory days has been increasing because inventory is not able to manage properly. They need to manage this, okay, but as per that, as I can see, it is not that much old company and newly listed in this stock market. We can observe this company for the long term investment because all these uh, fundamentals and technicals are showing very good stand for this one, especially cash flows, balance sheet, profit and loss statement, even their quarterly results. And if you compare with the peer, it is doing very well. So as per this all the data, if you are planning for the investment in this company, I think it can be a very good option for the long-term investment. Right? First of all, let me clear that I am not a savvy research analyst. So based on your research, you can invest in there. Thanks for the watching. Have a nice day.